If you were born before 1960, the IRS changed 3 rules that directly affect your bank account this year. None of them came with any personal notice. You are simply expected to know. And if you do not, consequences run from unexpected tax bills to federal penalties on money you thought was handled. Rule number 1 applies to anyone born between 1951 and 1959, and it went into full effect this year in a way that is already showing up on tax returns and bank statements across the country. Under a federal law called the Secure 2.0 Act, your required beginning date for required minimum distributions has arrived. If you were born in any year from 1951 through 1959, you must now begin taking required minimum distributions from your traditional IRA, your 401k, your 403b, and most other tax-deferred retirement accounts, starting at age 73. The IRS requires you to calculate a minimum withdrawal amount each year, and that amount lands in your bank account as taxable income, whether you wanted extra income that year or not. The formula is straightforward. You take your account balance as of December 31st of the previous year and divide it by a life expectancy factor the IRS assigns to your age. For a 73-year-old using the standard table, that factor is 26.5, which means a $500,000 traditional IRA produces a required minimum distribution of roughly $18,868. That money is taxable in full as ordinary income the moment it leaves the account. And there is a timing trap that catches first-year RMD recipients by surprise. The IRS gives you until April 1st of the following year to take your very first required minimum distribution. But if you use that grace period and delay your first distribution until April of 2027, you will owe your second distribution for 2027 by December 31st of that same year. 2 full distributions in 1 calendar year, both taxable, both counted toward your combined income for Medicare and Social Security purposes. What catches people off guard is not the withdrawal itself, but the downstream effects that land in the same tax year. That $18,000 distribution adds to your combined income for the Social Security taxation formula, potentially pushing a larger portion of your Social Security benefit into taxable territory. It can also directly affect your Medicare premiums through a mechanism called the IRMAA surcharge. The Social Security Administration uses your income from 2 years earlier to set your Medicare Part B and Part D premiums for the current year. In 2026, your 2024 income determines whether you owe a surcharge on top of the standard $202.90 monthly Part B premium. That surcharge starts for single filers with income above $109,000 and for married couples above $218,000. For someone whose income was just below those lines before required minimum distributions kicked in, the first year of mandatory withdrawals can be the exact income event that crosses the threshold and raises their Medicare premiums for the entire following year. The penalty for missing your required minimum distribution entirely is 25% of the amount you should have withdrawn, reduced to 10% if you correct the mistake within 2 years. But the key point for anyone born in this window is that the clock has now started. If you turned 73 this year or earlier and you have not begun taking required minimum distributions from every traditional retirement account you own, you have a compliance problem that compounds over time. Before we get to Rules 2 and 3, subscribe now, because Rule 3 is the one that has already caught people completely off guard this year, and it involves a penalty most beneficiaries had no idea was back in effect. Rule number 2 is not about withdrawals you have to take from your own accounts. It is about withdrawals that other people take from yours after you pass away, and how a change finalized by the IRS affects what happens to the money you plan to leave behind. The Secure Act, passed in 2019, changed the rules for most non-spouse beneficiaries who inherit a traditional IRA. The old stretch IRA strategy, which allowed beneficiaries to withdraw inherited IRA money gradually over their entire lifetime, was eliminated for most heirs who inherit accounts from someone who passed away after December 31st of 2019. In its place, the IRS now requires most non-spouse beneficiaries to fully empty an inherited IRA within 10 years of the original account owner's death. What was unresolved for years, and what the IRS finally clarified in final regulations published in July 2024, is whether annual withdrawals are required during that 10-year window or whether the beneficiary can simply wait and take everything in year 10. The IRS answered that question definitively. If the original account owner had already reached their required beginning date for distributions at the time of their death, the beneficiary must take annual required minimum distributions in years 1 through 9 of the 10-year window, in addition to emptying the account by the end of year 10. So if you pass away at age 75 with a traditional IRA still growing inside it, your adult child who inherits that account cannot simply let it grow untouched for 10 years and then take the full balance. They must begin taking required minimum distributions every year starting the year after your death, calculated against their own life expectancy, and the entire account must be empty by year 10 regardless. The reason this matters to your bank account right now is straightforward. If you have already named beneficiaries on your retirement accounts, the rules under which those beneficiaries will inherit have changed significantly. And if you never updated your estate strategy after 2019 to account for the Secure Act, the plan you put in place no longer reflects how the IRS will actually treat your accounts after you are gone. Beneficiaries who inherit traditional IRAs under the 10-year rule and are also required to take annual distributions during that window will be receiving taxable income every year whether they need it or not, at whatever tax bracket their own income puts them in at the time. Rule number 3 is the one affecting bank accounts most directly right now, and it involves a penalty that was on pause for 4 years before being fully reinstated, beginning with the 2025 tax year and continuing through 2026. Starting in 2025, the IRS began enforcing penalties on inherited IRA beneficiaries who missed required minimum distributions during the 10-year window, specifically for beneficiaries who inherited accounts from someone who had already been taking required minimum distributions before they passed. The IRS had waived those penalties from 2021 through 2024, a 4-year period during which many beneficiaries reasonably assumed no annual distributions were required. That waiver ended. The penalty is 25% of any required minimum distribution amount that was not withdrawn on time, reduced to 10% if corrected within 2 years. If you inherited a traditional IRA from a parent or a spouse who had already started taking required minimum distributions and they passed away in 2020, 2021, 2022, or 2023, and you did not take distributions in the years since, the missed distributions are not forgiven retroactively, but the penalty waiver for those prior years still protects you for anything missed before 2025. Starting with the 2025 distribution year, penalties are fully back in effect, and the IRS has made clear through published guidance that this enforcement is not being waived again. This has already resulted in beneficiaries who thought they were following the rules suddenly discovering they should have been withdrawing money annually, and that those funds should have been landing in their bank accounts and showing up on their tax returns in each of the years since inheriting the account. So to bring all three of these together, if you were born before 1960, rule number 1 means the IRS is now watching your traditional retirement accounts for required minimum distributions that must come out every single year and be deposited into your taxable accounts or bank account, with a penalty for any amount you miss. Rule number 2 means the strategy you put in place to protect those accounts for your family after you are gone may be based on rules that no longer exist, and the accounts you plan to pass on may be subject to very different withdrawal requirements than you expected. Rule number 3 means that if you are already a beneficiary of someone else's IRA, you may owe distributions this year that you did not realize were required, because the penalty waiver that gave beneficiaries breathing room for 4 years has now expired. None of these 3 rules were announced with any fanfare targeted at retirees in plain language. They were written into law through complex legislation, clarified through IRS guidance documents, and enforced through penalty notices that arrive in the mail without advance warning. The most important thing you can do right now is speak with a tax professional or financial advisor who is current on the 2024 and 2025 IRS guidance before year end, because the correction window for missed distributions does exist, but it closes quickly. And once that window closes, the full penalty amount is owed. If you were born before 1960, drop a comment with your age and which of these 3 rules affects your situation most directly. And if this helped you catch something before it became a problem, subscribe now, because there is a lot happening in retirement tax law right now, and most of it is not being explained in plain language anywhere.